Hey everyone, welcome to this explainer. Today, we're diving straight into the absolutely historic market events of June 2026. We're going to decode exactly what the smart money is doing behind the scenes right now, and more importantly, how you can position yourself so you aren't left in the dust. Let's get right into it, because what we're witnessing here isn't just a simple market dip, it's a fundamental structural realignment of global capital. So let's kick things off with a number that literally made jaws drop on the trading floor. $1.1 trillion. That is the exact amount of market value wiped out from the top 9 tech megacaps in a single day. If you were watching the tickers, it felt like the floor just gave out. We're talking Apple, Microsoft, Nvidia, Alphabet, the completely untouchable titans of the last decade, all taking a sudden and brutal haircut. But hey, before we all start hitting the panic button, let's take a breath. We need to remember this incredibly insightful perspective from Morgan Stanley's Mike Wilson. He reminds us that after a massive 96% year-to-date climb, this is really just a necessary, healthy reset. When the market is sitting 35% above its 50-day moving average, which is the widest gap we've seen in 25 years, by the way, a correction isn't just possible, it's practically inevitable. We're really just returning to levels we saw a few weeks ago. To help us make sense of this chaotic news cycle, here's our roadmap for today. We'll quickly cover the trillion-dollar tech wipeout, the underlying economic and geopolitical pressures, the wild SpaceX liquidity drain, key corporate catalysts, the behavioral shift in prediction markets, and finally, where that capital is actually rotating. All right, let's jump right into Section 1, the trillion-dollar CAC wipeout, and what this historic drop actually looked like. The Nasdaq completely cratered by 4.2%, suffering its biggest one-day point decline on record. Naturally, it dragged the S&P 500 down 2.6% with it for its worst weekly performance since May 2025. But the true epicenter of this earthquake? It was what we're calling the chip crater. The semiconductor index plunged a massive 10.3%, literally its worst day since March 2020. We saw absolute high flyers like Micron down 13.3% and Nvidia dropping 6%. All that exuberance surrounding hardware was violently priced back to reality. Moving on to Section 2. The big question is, why is this happening right now? That brings us to the economic and geopolitical pressures. Right now, we are trapped in what's being called the economic pivot paradox. On one side of the scale, we have a surprisingly hot economy. May non-farm payrolls added 172,000 jobs, which keeps the rolling 3-month average incredibly strong. But here's the catch. That strong footing has completely destroyed investor hopes for near-term interest rate cuts. The cost of capital is staying high, which is forcing investors to brutally reprice equity multiples across the board. And that paradox shot Treasury yields up 12 to 16 basis points overnight, landing at exactly 4.575%. Now, why does that specific number matter to us? Well, history shows us that when the 10-year yield sustains above 4.5%, it acts like a massive multiple compressor. It hits interest-sensitive sectors the hardest, severely punishing those high-growth tech stocks that rely on massive future earnings to justify their current sky-high prices. And, of course, adding fuel to the fire, we have major geopolitical tensions. The conflict in Iran has slashed global oil supply by 4 to 5 million barrels a day. The market managed to survive the initial shock through some clever workarounds, but those easy workarounds are pretty much exhausted now. This is creating a definitive Strait of Hormuz premium. JP Morgan is actually projecting that for every additional month the strait stays closed, it adds a 15 per barrel premium to upcoming Q4 estimates. It's a massive, massive inflationary pressure cooker. Okay, Section 3, the SpaceX liquidity drain. This is where we see capital getting sucked right out of the room. This is such a fascinating hidden force in the market right now. We have the looming $75 billion SpaceX IPO, which, by the way, is a raise more than double the Saudi Aramco record. Because SpaceX is going to join the Nasdaq 100 in just 15 trading days, passive index funds have strict mandates. They are mathematically forced to buy 10 to 15% of those shares. So where does all that cash come from? Well, it's effectively acting as a giant vacuum, pulling liquidity directly out of giants like Apple, Amazon, and Nvidia just to make room for SpaceX. And when you actually pop the hood and break down their sum of the parts valuation, you uncover this incredible paradox. Their total projected revenue for 2036 sits at an astronomical $420 billion. You've got Starlink as a highly profitable broadband monopoly targeting $120 billion. You have the Space and Starship division targeting $40 billion. But then you have their AI division, XAI, valued at $160 billion, which is currently generating a massive $6.4 billion operating loss. So they're the most dominant space company in history, but at the exact same time, they're running one of the most valuable, money-losing AI operations on the planet. It's a crazy valuation tightrope. Moving into Section 4, let's zoom in a bit and look at some key corporate catalysts, specifically how Apple and Boeing are navigating this moment. It's literally a tale of two entirely different corporate tests right now. On one hand, you have Apple attempting to overcome its perceived AI deficit at WWDC. They've got to prove they aren't falling behind by rolling out a totally revamped on-device Siri. This is likely Tim Cook's final major keynote. And fun fact, historically, Apple shares drop on WWDC day, but tend to rise around 14% 3 months later. Then, contrasting sharply with that, you have Boeing bracing for the final accident report on the tragic Air India crash right or its 1-year anniversary. Investors are watching like hawks for any surprise recommendations that could derail CEO Kelly Ortberg's massive production rebuild. All right, Section 5, the prediction market shift. This is a massive behavioral paradigm shift playing out in real time. With a mind-blowing $50 billion expected to be wagered globally during the 39-day World Cup, the actual mechanics of how that money flows are transforming. Bettors are abandoning the heavy regulatory friction and baked-in house margins of traditional sportsbooks. I mean, DraftKings actually saw a 3.1% drop in Q1. Instead, users are flocking to the transparent, peer-to-peer growth of prediction markets like Kalshi and Polymarket. Kalshi alone recorded $14.8 billion traded in April. That's a 3,100% year-over-year explosion, largely because they can flourish in massive, unlegalized sports betting states like California and Texas. Which brings us to our final part, Section 6, the capital rotation pipeline. Where's the smart money actually going? Just take a look at the gauntlet we're running in this one chaotic week. It starts Monday with Apple's WWDC, rolls right into Wednesday's absolutely critical CPI inflation data, followed on Thursday by the PPI release and the massive $1.8 trillion target pricing of the SpaceX IPO. And it all culminates on Friday with the ultimate liquidity event. SpaceX officially begins trading, guaranteeing massive retail and institutional volume. So what this timeline tells us is that capital isn't just evaporating, it's actively rotating. Because S&P 500 earnings revision breadth is at a new cycle high of 26%, the economic reality actually supports a broader rally. Money is flowing out of momentum tech and into broad markets like consumer discretionary and regional banks. It's moving out of megacap tech into cash to front-run that massive passive index buying for SpaceX, and it's flowing out of volatility into geopolitical hedges like energy and defense, with players like ExxonMobil stepping up to capture that Strait of Hormuz premium. And that brings us to the big takeaway here. Despite a staggering $1.1 trillion tech wipeout, delayed rate cuts, intense geopolitical friction, and a massive IPO liquidity drain, the underlying fundamentals remain historically strong. Morgan Stanley's baseline target for the S&P 500 is holding incredibly firm at 8,000 by year-end. The broader market is expanding, not collapsing. So as we wrap up this explainer, I want to leave you with this thought. Nobody rings a bell at the top. But a healthy reset is not the end of a revolution. That extreme exuberance had to be cleared out to build a more sustainable foundation. The capital is shifting rapidly into new pipelines, new market mechanics, and entirely new megacaps. So the only question left to ask yourself is, are you positioned for the next phase of this market evolution, or are you still holding on to the last one? Thanks so much for joining me on this deep dive. Stay focused out there, and I'll see you in the next explainer.